If you earn £35,000 and your employer offers a 5% pension match, you could be leaving over £1,750 a year sitting on the table. And that is before the government adds its own contribution on top. This video is about understanding exactly how those two separate sources of free money work, so you can decide whether you are actually claiming both of them. 3 things you will understand by the end of this video. First, how tax relief turns an £800 contribution into £1,000 in your pension, at no extra cost to you. Second, why salary sacrifice can make that contribution cost even less than you think. And third, how to check whether you are actually claiming your full employer match right now. Let us start by being precise, because the phrase free money gets thrown around a lot. In this context, it refers to 2 distinct things, and they are worth separating clearly. The first is government tax relief. Every pound you put into a pension comes from money that has already been taxed, so HMRC gives some of that tax back by topping up your contribution. The second is your employer contribution. Your employer pays money into your pension on top of your salary, and it costs you nothing directly from your take-home pay. These are not the same mechanism, and understanding each one separately is the whole point of this video. One more thing to flag up front. This is not a guaranteed return, and we are not saying pension contributions are always the right call for everyone. What we are saying is that the mechanism exists, it is documented, and roughly 8.4 million UK employees are now auto-enrolled into a workplace pension, yet many are contributing only the legal minimum and missing the employer top-up they are already entitled to. That gap between what is available and what people actually claim is what this video is about. Here is how tax relief actually works for a basic rate taxpayer. You pay income tax at 20% on most of your earnings. So when you put £800 into your pension, that £800 came from money that was already taxed. HMRC acknowledges that and adds the 20% tax back in, which means your pension provider receives £1,000. You personally transferred £800. The pension pot shows £1,000. The difference, £200, came from HMRC. That is the basic rate top-up, and it happens automatically for most workplace pension schemes and personal pensions. Now here is the counterintuitive part. Paying 40% income tax is usually not good news. But when it comes to pension contributions, it means you get the biggest government top-up of anyone. A higher rate taxpayer contributing enough to put £1,000 into their pension can claim the extra 20% relief through self-assessment, bringing the effective personal cost down to £600. An additional rate taxpayer, paying 45%, can bring that same £1,000 pension contribution down to an effective cost of £550. The pension pot in all 3 cases holds £1,000. The difference is simply how much of your own money it took to get there. To be clear on the process for higher rate and additional rate taxpayers, the extra relief does not happen automatically in most cases. You claim it through your self-assessment tax return, or by contacting HMRC directly. If you pay 40% or 45% tax and you have not been doing this, it is worth checking because the amounts can be meaningful over multiple years. As always, speak to a licensed professional about your specific situation. So far we have looked at tax relief on contributions from your net pay. Salary sacrifice is a different arrangement, and it pushes the cost down even further. The way it works is this: instead of taking your full salary and then contributing to your pension from your take-home pay, you agree with your employer to take a slightly lower salary, and your employer pays the difference directly into your pension as an employer contribution. Because the contribution never passes through your pay packet, national insurance is never calculated on it. That saves you employee national insurance, which is currently 8% on earnings above the threshold. And here is where it becomes interesting for employers too. Employer national insurance is currently 13.8%. When you contribute via salary sacrifice, your employer does not pay national insurance on that portion of compensation either. Many employers pass some or all of that saving back to their employees by adding it to the pension contribution. Not all do, but many do, and it is worth asking. Let us put a real number on it. Jamie is 34 years old and earns £40,000. Jamie contributes £2,000 a year to their pension. If Jamie does that via salary sacrifice instead of from net pay, they save roughly £160 in national insurance over the year. The pension balance looks identical in both cases. The difference is purely in Jamie's take-home pay. The sacrifice route costs £160 less in real terms. Over a working life, that kind of difference, compounded and reinvested, becomes meaningful. This is not advice about what Jamie should do. It is just the arithmetic. Now to the part that is arguably the most straightforward, and also the most commonly missed. Auto-enrollment sets a legal floor. Your employer must contribute at least 3% of your qualifying earnings, and the combined total, employer plus employee, must reach at least 8%. But that is a floor, not a ceiling. Many employers offer to match higher contributions if the employee also puts in more. The critical word is if. The match is conditional. If you only contribute the minimum, you only get the minimum match. Here is what that looks like over time. Take two employees on the same salary of £35,000. Employee A contributes exactly the auto-enrollment minimum, getting a 3% employer contribution. Employee B contributes enough to unlock a 5% employer match. Both use a 5% illustrative growth rate over 20 years. Employee B's pot is materially larger, not because they earned more or took more investment risk, but simply because they claimed more of what was available. The chart does the convincing. We do not need to tell you what to do with that information. The reason many people miss this is simply that they never checked. Pension scheme documentation is not the most exciting reading material, but it usually contains one key table: what the employer will contribute at each employee contribution level. That table is the number you need. It is in your staff handbook, your pension scheme welcome pack, or your HR department can tell you in one email. So here is the one concrete thing this video is pointing toward. Find out what your employer's full match threshold actually is. Not what you assumed, not what a colleague mentioned, the actual number from the actual documentation. If you are in the UK, that information is almost always in your workplace pension scheme details. While you are there, it is worth noting that the annual allowance for pension contributions in 2024-25 is £60,000, or 100% of your earnings, whichever is lower. The average UK earner contributing only the auto-enrollment minimum is using a very small fraction of that. Which means there is headroom, for most people, to contribute more if they choose to. A quick note for viewers outside the UK. In Canada, your employer may offer matching contributions inside a group RRSP or a defined contribution pension plan. The logic is identical. There is usually a threshold you must reach to claim the full match. In the US, the same principle applies to 401k employer matching. The specific numbers differ by plan, but the underlying question is the same: are you contributing enough to unlock everything your employer has offered to put in? None of this is a recommendation to contribute a specific amount, or to use any particular pension product. What it is a prompt to know the number. Once you know the threshold your employer uses, you can make an informed decision. That is the only goal of this video. Tomorrow we look at another money decision worth getting right, so subscribe and I will see you then. Quick recap of the three things. First, basic rate tax relief means an £800 personal contribution becomes £1,000 in your pension. Higher rate and additional rate taxpayers can claim even more through self-assessment. Second, salary sacrifice reduces the real cost further by removing national insurance from the equation for you and potentially for your employer. Third, the employer match is only valuable if you contribute enough to unlock it. Many people currently do not, simply because they have never checked what the threshold is. A quick reminder: this is educational content only, not financial, tax, or legal advice. Speak to a licensed professional in your jurisdiction before making any decisions.